Welcome to ValueVest Daily. Today, we're diving deep into one of the most dangerous and honestly, one of the most costly hidden traps in all of investing, overconfidence. Yeah, it's that little mental glitch that convinces us we can outsmart the market, and it often leads to some pretty disastrous results. So, in this explainer, we're going to break down exactly what it is, show you how it costs you real money, and then lay out a clear system to protect your portfolio from your own brain.
Now, if you think overconfidence is just a problem for, beginners or amateur investors, you really need to think again. This quote, it's from Warren Buffett himself, admitting a massive, costly mistake. He bought a shoe company he was absolutely certain was going to be a home run, and he was just plain wrong. It's such a powerful reminder. If this cognitive bias can trip up the Oracle of Omaha, it can absolutely 100% trip up any of us.
To really, truly understand the stakes here, let's look at one of the most dramatic financial blow-ups in modern history. And this isn't a story about foolish investors. Oh no. This is a story about certified geniuses who were so convinced of their own brilliance that they almost brought down the entire global economy.
I mean, the sheer brainpower behind long-term capital management, or LTCM, was just staggering. It was run by literal Nobel Prize winners. These are the people who wrote the textbooks on financial theory. They were a textbook case of overconfidence. They had over-precision in their super-complex mathematical models, which they thought could predict market moves with near certainty, and they had over-placement, believing their genius put them on a totally different level from everyone else. This toxic combo led them to take on insane amounts of leverage, completely ignoring the possibility that their perfect models could fail. And when they did fail, wow! The fund lost over $4.6 billion in just a few months, forcing a massive bailout to prevent a complete global meltdown. It's the ultimate proof that intelligence is absolutely no defense against overconfidence.
So that LTCM story, it's not just a piece of history. It's a huge warning sign about a glitch that's hardwired into our own brains. This isn't about being smart or dumb. It's about a universal human bias that affects all of us, especially when our money is on the line. So let's break down the 3 distinct ways this nasty little glitch shows up.
Okay, so at its core, overconfidence is really just the gap between what you think you know and what you actually know. It's that feeling of total certainty you get right before you place a big bet. A feeling that, let's be honest, often isn't backed up by objective reality. And investing, that gap can be absolutely devastating to your wealth.
The first way this shows up is overestimation. You know that little voice in your head that says, "Oh, I've got this. I can see the crash coming," or "I know exactly when to buy this stock at the absolute bottom." That's it. It's the belief that you have some kind of special skill for timing the market, a feat that, by the way, decades of data show is practically impossible to do consistently.
Next up is overplacement, and this one is all about how we compare ourselves to others. This statistic is just fantastic. Studies consistently show that over 90% of drivers believe they're above average. Well, you don't have to be a math genius to know that's impossible, but it's how our brains work. And guess what? The exact same thing happens in investing. Most of us secretly believe we're better stock pickers than the average Joe, even when there's zero evidence to back it up.
And finally, there's over-precision. This is all about being way too certain about things that are, by nature, uncertain. For example, an investor might feel, say, 90% sure a stock is going to hit a certain price. In reality, predictions like that are historically much closer to a coin flip. This false precision is what leads people to concentrate their bets, to go all in, taking on way too much risk because they've mistaken a possibility for a sure thing.
Okay, so we've defined the psychological glitch. We know what it looks like. But what's the actual, real-world financial damage? Well, the hard data on what overconfidence does to a portfolio is, well, it's pretty staggering.
Let's start with behavior. Landmark studies have shown that the most overconfident investors trade way more often, up to 67% more frequently. And it just makes sense, right? If you believe you're smarter than everyone else and you think you can predict the future, you're going to be constantly moving your money around, chasing that next big idea.
And here it is. Here's the direct financial hit. All that extra activity, all that trading, it's not helping, it's hurting, big time. After you account for trading costs and taxes, that excessive trading chops a full 1.7% off their annual returns compared to the market. Now, 1.7% might not sound like a lot, but over decades, that small difference can cost you hundreds of thousands of dollars in lost compounding. It's huge.
This chart really shows the long-term damage in stark relief. Look at this. While the S&P 500 index delivered nearly a 10% annual return over 20 years, the average investor? They only earned about 3.5%.
That enormous difference is what we call the behavior gap. It's literally the price investors pay for making emotional decisions driven by fear, greed, and yep, you guessed it, overconfidence, constantly trying to outsmart the market instead of just being in the market.
So I know the situation might seem a little grim. We're all fighting a bias that's literally hardwired into our DNA. But here's the good news. You don't have to win some impossible battle of willpower. Instead, you can build a system, a clear set of rules that protects your portfolio from your own worst instincts.
This is the key question, isn't it? If this bias is just part of how we're built, what can we possibly do about it? Well, the answer isn't to just think harder or try to outsmart yourself. The real answer is to create a process that makes your biased brain pretty much irrelevant to the decision. Here's how we do it.
All right, here's a simple 5-step system you can use. First, self-assess. Actually keep a log of your predictions and track your real results. Trust me, the data will be humbling. Second, limit your trading. Create some friction for yourself. Set a firm rule, like you only rebalance or trade 4 times a year. This prevents those impulsive moves. Third, diversify. Seriously, don't bet the farm on that one idea you're so sure about. Fourth, use data, not your gut. Write down in a journal every investment decision and your reasons why. This forces logic to take the driver's seat over emotion. And finally, number 5, automate. Use dollar-cost averaging to invest automatically every month. It completely removes the temptation of trying to time the market.
And you know what? Building that system is easier today than it has ever been, thanks to some really powerful and simple investment tools out there. They're basically designed to help you achieve your goals by taking your biased brain out of the equation. This is how you put your entire strategy on autopilot.
Really, the most effective antidote to overconfident stock picking is the simple, low-cost index fund, or ETF. A fund like VTI, for example, gives you a tiny piece of thousands of US stocks. You're not betting on one company, you're betting on the entire American economy. Now, it's important to notice the performance data here is from a really strong year. In other years, these numbers could easily be negative. And that's a super crucial point. Even a perfectly diversified low-cost portfolio is going to lose value sometimes. The system isn't about never losing. It's about staying invested through the downturns so you're there for the eventual recovery. It helps you avoid those emotional mistakes that turn temporary paper losses into permanent real ones.
Okay, before we wrap this up, just an important reminder. Everything we talked about here is for educational purposes only. This is not personalized financial or tax advice. Please, always consult with a qualified professional who understands your specific situation.
So, let's end with this one question. Are you the one managing your money, or is your overconfidence managing it for you? Are your decisions based on a sound, repeatable process, or are they based on a gut feeling that you know something the rest of the market doesn't? Just acknowledging this bias exists is the most important step you can take toward building a process that protects you from it and ultimately helps you reach your long-term financial goals. Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunity.